Hello, everyone. I hope you're doing exceptionally well today. Welcome back to Canadian Finance Truths, where we really talk about out of the box finance topics. Now, I've upgraded my computers to Windows 11. The layout is slightly different. We may run into some technical issues. We will get through it. This morning, actually, I got a good comment from Uvunk Aslan. I'm sorry if I pronounced that incorrectly. And the comment was, thanks for the video and the other videos on your channel. It's great to have a Canadian view of infinite banking. I want to combine infinite banking and real estate investment, specifically the BRRRR strategy. Is this a good idea? What do you think about putting all of my money in my whole life policy before investing in real estate? Let's say I have $1 million. What is the maximum amount I can put in my whole life? When will I be able to borrow against my policy at the earliest? What is the maximum percentage I can borrow? I'll be grateful if you can make a video answering all my questions. Well, here we are. We will answer them. I do apologize if the audio is a little wonky. I am at my office, and typically I record these from my home office, and the sound isn't as good as I would otherwise look at doing. So first, let's talk about a couple things. We'll answer these in order. So the first one is you want to combine infinite banking and real estate. And so for those who are new to the channel, essentially the way that infinite banking works, we'll talk about this, is that you earn dollars, and most people, what they do is they put it in a checking account, and then they go and they spend this money. And it's a very inefficient approach because the interest that's earned on this checking account is very, very low. I wonder if I can increase the size of my pen right here. Okay. The interest that's earned is very low, and so it isn't that great of a mechanism to generate wealth, and you lose out. There's a big opportunity cost that's here. And so essentially the way the infinite banking process works is the money that you earn ends up getting put into an IBC whole life insurance policy, and then ultimately you use this money to then go make investments which earn money, and then ultimately the money that you earn, you reinvest it into the infinite banking policy. And the mechanism that you use to use money is through policy loans. Now, I've got videos on this. I'm not going to dive into it, but this is it in a nutshell. The idea is to create a perpetual system whereby when you use your money for investments, lifestyle, whatever, you then put money back in and you create this process, which eventually removes the need of having banks in your life and allows you to capitalize on the problem that exists up here where there's really no money generated on your idle cash. Essentially, you can generate an internal rate of return anywhere typically from about 3 to 4%, give or take, on a tax advantaged basis. Okay, and then the BRRRR strategy is buy, rehab, essentially, or renovate, rent, refinance, and repeat. So the idea behind this is, can these two things work together? Well, of course, because this buy, rent, refinance, repeat requires capital, and it's also an investment. And so because of this process can work tremendously well. The problem that most people face is that they have opportunities that they're hunting for, like the BRRRR strategy, real estate investments. Their money sits idly doing nothing, and then you have the opportunity that costs doing nothing. So the infinite banking process just allows you to capitalize on that process and create this forever banking system. So is this a good idea? Yes, it's not a bad idea, and it can be used to, capitalize on the money that you would otherwise be losing when your money is doing nothing. I hope that answers that question. So then the second thing is, what do you think about putting all of my money in whole life policy before investing into real estate? So I'm going to be a little contrarian here, because if you listen to the infinite banking purists, and I know I didn't mention this, but I'm not a life insurance agent. I'm not a financial advisor by any means. I'm just passionate about this type of stuff. But anyway, the purists, they would actually want you to put every single penny that you have so that you can maximize every single dollar that occurs in the infinite banking policy, which isn't necessarily a bad thing. There's nothing wrong with wanting to maximize the money that's inside of this infinite banking policy, and just maximizing the dollars you spend. The problem with this is that there is a quote unquote cost of implementing the infinite banking process. And there are a few variables that I don't want to say necessarily make it risky, but go watch my videos on the negatives of infinite banking. You can hear some of the negatives that exists in this whole process. Uh, it is long story short, I would not put every single penny that I have into infinite banking. I would only put what I reasonably expect to need, either immediately or what I reasonably expect to need over the next few years. Okay. And so, he extrapolates further. Let's say I have $1 million. What is the maximum amount I can put in my whole life policy? So, you can't really front end load whole life insurance policies. Now, again, I'm not a life insurance agent. There may be a single pay whole life insurance policy, but from my understanding, all the research I've done, if they exist, they would not be that efficient for a infinite banking process. But typically speaking, in your first year of infinite banking, you're typically losing anywhere from like 15 to 30% of the money you put in. Most policies are closer to this, 20 to 30% loss. All right. The infinite banking purists say this is, your cost of starting up your bank. In reality, it's the money that is going to go to a whole host of things. This isn't a negative unless you cancel your plan instantaneously, as most policies break even kind of in year 4 or 5, all the way up to year 8, depending on your age, how much money you're putting in, the whole 9 yards. Okay. So ultimately, you have to realize that you have to be able to fund these if you want to maintain them for typically anywhere between, say 5 to 8 years in length. And so to kind of illustrate this, I've taken this $1 million here and I have done an equitable life illustration. And all I did was I said, let's invest the $1 million over 5 years. So you'll notice that we have invested the $1 million. Okay. You at the end of 5 years have a little over $1 million. So you've broke even at year 5 here. Your required annual premium on $200,000, right, is $82,000. Okay. And what I've done is I've said, all right, let's say you only have $1 million. Let's offset this, which means that the policy continues to be self serving and pay its own cost for essentially the lifetime of the policy. Now, I'm going to get a little technical here, but essentially what ends up happening is uh, the dividends that are earned are used to purchase what's called paid up additions, which is additional insurance. This is why your insurance cost increases over time. And so you go from having $5 million of coverage to $7.3 million of coverage. Well, what ends up occurring, if you notice, is that your required premium, $82,000, is more than the actual dividend that's generated from the policy. So what ends up happening is the insurance company sells these paid up additions to fund and finance the difference. Okay. And this is why you'll notice that your insurance actually decreases over time. Eventually, though, several years down the road, further than this chart generates here, your dividend will start to exceed the $82,000 and your death benefit will start to increase. But depending on your age, that will be very, very, very well into the future. Now, the biggest assumption that this is based upon is this is based upon the current dividend scale. As the dividend scale increases or decreases, these numbers will change. If the amount of revenue and the dividends decrease, then it's very possible that if you offset at the earliest time possible, which in this policy is that 5th year, that you'll actually end up lapsing the policy in time unless you want to continue to fund the policy, which very well may be possible. I'll talk about that in a second, okay? So instead, what I've said is, okay, let's say we're going to fund it out over 8 years. So what we've done here is we've now funded this out over 8 years, and you'll see, and I've offset it at the 8th year. You've got $1.1 million. You're trying to break even in 7 year, 8 year, okay, on the $1 million. And I bet you the break even is actually much closer, but I'm talking about the actual $1 million itself, right? Um, this policy, in theory, should be able to survive a considerable amount of dividend scale fluctuation because you've actually funded it past this policy. Earliest break even would be year 5 as well. So you funded it for an additional 3 years, giving it that much more wiggle room. So, to answer your question, how much can you put in your whole life policy? Well, it really depends. The shortest period of time I'd recommend is $200,000 a year. So the 5 years get to the break even component here. You could theoretically try to slam in more, assuming that your income and or the investments that you're going to make are going to be able to sustain things moving forward. And I'll talk about that in a second. Um, but if I was you, and I'm intrinsically a little bit more conservative, safety first, then return, I would be going with this 8 year uh, kind of, I guess, investment period, right? Because you can offset it, go get a bank loan against this, and then you're basically good to go. Um, so I hope that answers that question. How much can you put in? It really depends on how you want to structure it. You could do more than the 200,000, but that would be the maximum I would do because it carries considerably more risk. When will I be able to borrow against my policy at the earliest? Every insurance company is different. So Equitable, for example, allows you to borrow approximately 50% of the money that you've invested in your the first day that you invest the money, assuming you pay the premium annually. So this is a little known fact. So let's say January 1st, you go and you invest the $200,000. All right. Well, on January 1st, you can typically borrow approximately half. Okay. And then typically you can borrow 90% of the cash value when it's fully vested, let's call it. Okay. So December 31st, you would be able to borrow up to approximately $180,000. Now, these numbers are very basic. It will depend on the company, all this type of stuff. So this is with Equitable. However, some insurance companies won't let you borrow any cash value in the first year, which, if you're looking to invest in real estate concurrently with starting these policies, then ultimately you really need to make sure that you understand these things ahead of time, because the last thing you want to do is fund a policy needing the money and then you don't have the money, right? Now, in your instance, in your question, if you had $1 million cash, that may not necessarily matter. So you may want to look at potentially rate of return or specific functionality, like for example, Equitable. I believe up until last year, if your policy was offset, you couldn't actually obtain policy loans from them, which is a big deal with infinite banking. Now that doesn't mean that was the only option. That's a topic for another day, but it was certainly a concern. So really, I would say in the best case scenario, you can probably access immediately up to 50%. So that's typically how that ends up working. So I believe I've answered all of your questions here, but here's something else that gets really interesting. So we've talked about this idea of investing the $1 million, okay? And I've done everything on here, assuming that, the only money you have is $1 million and you're never going to make an extra penny. Except to obviously repay policy loans through this BRRRR strategy process. But the idea is, and very basic, let's say that you invest, say, $100,000 in a property as a down payment, say $50,000 in cash for the rehab. You rent, you refinance the process, and in the process of refinancing, you now refinance out $250,000. I'm making these numbers up, of course. You now have $100,000 positive basis. Well, the reality is that you can start past your $1 million funding these required annual premiums, which will ultimately increase your cash value, which will allow you to have more and more and more money. And it will reduce that opportunity cost that we discovered up here, where the money sits idly in your checking account. So you can actually convert cash that would be, again, sitting there waiting for an opportunity to perpetually through the future earn an internal rate of return. One thing that I find quite interesting, actually, is that this larger policy here, when you offset it in year 5, has an internal rate of return of anywhere between like 3.5 to 3.8%, give or take. Basing it off of memory, I didn't write this down anywhere. But this policy here actually ends up having an internal rate of return, depending on the year, of approximately 4%. I'm assuming it's because you've funded the policy for a longer period of time. So even when you look at these two examples, you very well may be better off funding these on a longer basis than a shorter basis. And you can see this because at year 20, you end up having a cash value of $1.849 million. And over here at year 20, you have $1.856 million of total cash value. Now, remember, when you're looking at infinite banking from an investment perspective, you're not getting massive returns. Although I would argue that a 4% in a whole life insurance policy is equivalent to probably like a 6.5, 7%. Not in a whole life policy, but this is going to be your liquid, safe capital that you can access at any time that continues to compound and continues to grow. Anyway, I hope that answers your question. This video is a whole lot longer than I thought it was going to be, but I really appreciate the question. And if anyone else has any question, I'm more than happy to make videos about it. I love this stuff, love talking about it. I don't claim to be an expert. And so if you do and you are an expert and you want to chime in, please let us know what I've got right, what I've got wrong, other circumstances that we should think about, and we'll all learn together. So have yourself a wonderful day and yeah, make some money. Cheers. Bye.